Let me tell you something that nobody in the insurance industry wants you to figure out. You are probably overpaying right now, today, for coverage that might not even protect you the way you think it does. Not because you're bad with money, not because you weren't paying attention, but because the system is specifically designed so that you don't ask questions. And the scariest part? The mistakes that'll cost you thousands of dollars, you already made them before anything even went wrong. Today, we're fixing that. 5 mistakes, real numbers. Let's go. My name is Ricky, and I spend way too much time thinking about money people don't realize they're losing. If you're somebody who set up auto pay on your insurance and never looked back, this video was made specifically for you. Hit subscribe if this helps. Let's get into it. Here's how most people buy car insurance. You need it, you go online, you get a few quotes, you pick the one that doesn't make you wince too hard, and you move on with your life. And honestly, that makes complete sense. Nobody wakes up excited to spend 2 hours decoding insurance language. Terms like comprehensive coverage, liability limits, underinsured motorist protection. It sounds like it was designed to confuse you. So you just guess, and then you set up autopay, and then you forget about it. Sound familiar? Here's the problem with that. The average American pays around $1,700 a year for car insurance, according to Bankrate's 2024 data. That's $140 every single month. Over 10 years, that's $17,000 leaving your bank account. And most people have genuinely no idea if they're getting a fair deal on any of it. Now, here's what makes this worse. Insurance companies know exactly how this works. They know you're not going to read the fine print. They know you're probably not comparing quotes every year. They know inertia is on their side. So they use it. There's actually a term for it. Price optimization. It's when insurers gradually raise your rate year after year, banking on the fact that loyal customers don't leave. And it's completely legal in most states. You aren't being paranoid if you think your rate keeps creeping up. It probably is. The good news, every single mistake I'm about to walk you through is fixable. None of this is complicated. You just need to know where to look. And it starts with a mistake almost everyone makes before they even finish buying their policy. Before we get into the mistakes, I need to challenge something you probably believe right now. Most people think the goal with car insurance is simple. Pay as little as possible every month, keep the premium low, save money. That sounds logical, but that thinking is exactly what's costing people thousands. Here's a better way to think about it. Insurance is not a bill you set and forget. It's a contract you should be actively managing. Your life changes, your car's value changes, your driving record changes, but most people's policies, identical to the day they signed up, sometimes for years. And here's something that should genuinely make you uncomfortable. According to the Consumer Federation of America, drivers who shop their car insurance every single year save an average of $461 annually just from comparing quotes. That's $461 for maybe 20 minutes of work. Most people don't do it because they think loyalty gets rewarded. It doesn't. There's no discount for staying. There's no prize for autopay. The company isn't thinking about your loyalty, they're thinking about your inertia. So the first shift I want you to make today is this. Stop treating your insurance like it's permanent. It's not. It's a recurring financial decision. And like every financial decision, it should be revisited regularly. Because the moment you stop paying attention, that's the moment you start overpaying. Now, let's get into the actual mistakes. And I'm going to show you these through real people because numbers alone don't hit the same way as watching someone else make the exact mistake you're about to avoid. Meet Marcus. Marcus buys a used 2017 Honda Civic, paid $11,000 for it. He goes online, sees 2 plans. Plan A is $90 a month with a $500 deductible. Plan B is $65 a month with a $2,000 deductible. Plan B saves him $25 a month. That's $300 a year. Marcus picks Plan B. Feels smart. 6 months later, a shopping cart rolls into his door in a parking lot. Minor damage. Repair estimate comes back at $1,400. Marcus files his claim. Then he remembers his deductible is $2,000. Insurance pays nothing. Marcus pays $1,400 out of pocket. That $300 he saved on premiums cost him $1,400 in a single afternoon. And that's not even a serious accident. That's a parking lot. This is mistake number 1. choosing the lowest premium without running the math on the deductible. These two numbers don't live separately, they're connected. A lower premium almost always means a higher deductible, and a higher deductible means more money out of your pocket when something actually happens. The fix is simple. Add up 12 months of premiums, then add your deductible. That's your real annual cost if anything goes wrong. Compare that number across plans, not just the monthly premium. That one calculation changes everything. It's like buying the cheapest printer, then realizing the ink costs $80 every 2 months. The sticker price was never the real price. Now, let me introduce you to Danielle. Danielle drives a 2013 Toyota Camry, worth maybe $5,000. She dropped full collision coverage 2 years ago to save money, and honestly, that was a reasonable call. Paying for collision on a $5,000 car has diminishing returns. But Danielle made one critical mistake when she adjusted her policy. She didn't add uninsured motorist coverage. One Tuesday afternoon, someone runs a red light and totals her car. The other driver? No insurance. Danielle gets nothing. No payout, no coverage, no car. She's out $5,000 and suddenly needs transportation. This is mistake number 2, assuming your coverage protects you from other drivers. Here's what most people don't realize. About 1 in 8 drivers on the road has no insurance at all, according to the Insurance Research Council. 1 in 8. That's a lot of people sharing the road with you. Uninsured and underinsured motorist coverage is usually shockingly cheap to add. We're talking $10 to $20 a month in most states. Danielle could have protected herself for less than the cost of a streaming subscription. She just didn't know to ask. Now, here's where it gets really interesting, and honestly, a little infuriating. 2 years after Marcus bought his Civic, the car's market value has dropped to around $7,500. He's still carrying full collision and comprehensive coverage. Think about what that means. He's paying full coverage rates to protect a car that would only pay him $7,500 in a total loss. Meanwhile, over those 2 years, he's spent around $1,920 just in collision and comprehensive premiums. He spent $1,920 to protect $7,500. And that number gets worse every year as the car keeps depreciating. This is mistake number 3, not reassessing your coverage as your car gets older. There's actually a simple rule of thumb financial advisors use. If your annual collision and comprehensive premiums are more than 10% of your car's current market value, it's probably time to drop that coverage. Marcus could check his car's value on Kelley Blue Book right now. Takes 3 minutes. And that one check could save him $600 to $800 a year going forward. Now, let's talk about mistake number 4. And this one genuinely shocks people. State minimum liability coverage. In most states, the minimum required liability is around $25,000 per person for bodily injury. Sounds like a lot, until you realize that a single emergency room visit after a serious car accident can run $50,000 to $100,000 easily. 1 night in the ICU. Done. Over the limit. If you cause that accident, you are personally responsible for every dollar above your coverage limit, out of your savings, your paycheck, your future. And here's the cruel math. Increasing your liability from state minimum to $100,000 per person in most cases costs about $10 to $15 extra a month. That's $120 to $180 a year for protection that could be the difference between financial setback and financial devastation. Most people skip it because they don't understand what the numbers actually mean. Now you do. And mistake number 5, this one is the most quietly expensive of them all because it has nothing to do with what you drive or how you drive. It has to do with something you probably check for credit cards and mortgages, but never thought applied to your car insurance. Your credit score is affecting how much you pay for car insurance. And in most states, that is completely legal. I know. Take a second with that. Insurance companies in most of the country are allowed to use something called an insurance score when calculating your premium. It's similar to a credit score but weighted differently, and most people have absolutely no idea this is happening. Here's the number that should stop you cold. According to Consumer Reports, drivers with poor credit pay up to 91% more for car insurance for the exact same coverage, same car, same age, same driving record, same zip code. Nearly double just because of a credit score. Now, you might be thinking, that's not fair. And honestly, a lot of people agree with you.
California, Hawaii, and Massachusetts have actually banned this practice, but everywhere else, this is your reality. So what do you actually do with this? First, pull your free credit report at annualcreditreport.com. Look for errors. A single incorrect late payment dragging your score down could be costing you hundreds of dollars a year on insurance alone. Disputing errors is free and it works. Second, if your credit has improved since you first got your policy, call your insurer. Ask if your rate reflects your current credit profile. Some companies don't update it automatically. You have to ask. Third, and this ties directly into mistake number 5, shop around. Because different companies weight credit differently. Some put heavy emphasis on it, some barely factor it in. The only way to know where you stand is to get multiple quotes. According to Value Penguin, the price difference between the cheapest and most expensive
Quote for the exact same driver and same coverage can exceed $1,000 per year. $1,000, same coverage, different company. That is not a rounding error. That is a car payment, a vacation, an emergency fund contribution. Just sitting there, waiting for you to spend 20 minutes comparing. Here's the real lesson underneath all of this. The people who overpay for insurance their entire lives aren't careless people. They're just people who never built the habit of questioning recurring expenses. Most of us are good at noticing big financial decisions. Buying a house, taking out a loan, those feel important, so we pay attention. But $140 a month? That feels small, so it goes on auto pay and disappears into the background. And that's exactly how $1,700 over 10 years gets wasted. The habit that protects you isn't complicated. Once a year, maybe when your renewal notice comes, spend 20 minutes, pull 1 or 2 quotes, check your car's current value, read your declarations page. That's it. 20 minutes a year. That habit alone over a lifetime of driving is worth thousands of dollars. Small attention, real money. All right, let's bring it all together cleanly. 5 mistakes, real consequences, simple fixes. Mistake 1. Choosing the lowest premium without checking your deductible. Always calculate 12 months of premiums plus your deductible. That's your actual cost if anything goes wrong. Never just look at the monthly number alone. Mistake 2. Assuming your coverage protects you from other drivers. 1 in 8 drivers on the road has no insurance. Add uninsured motorist coverage. It costs almost nothing and protects you from a problem that's completely outside your control. Mistake 3. Not adjusting coverage as your car ages. Check your car's current market value once a year. If your annual collision and comprehensive premiums exceed 10% of that value, it's time to reassess. Mistake 4. Carrying state minimum liability. Minimum limits are embarrassingly low. Increasing to $100,000 per person often costs $10 to $15 extra a month. The protection difference is enormous. Do it. Mistake 5. Only getting 1 quote and ignoring how your credit score affects your rate. Shop every single year. Check your credit report for errors. Ask your insurer if your improved credit is reflected in your premium. None of this is complicated. You don't need a financial advisor to fix any of this. You need an hour, one time, and then 20 minutes every year after that. The goal isn't just to have insurance, it's to have the right insurance at the right price for where you actually are in life right now. Because every dollar you overpay on insurance is a dollar that could be sitting in your savings, building something, working for you. That's the whole game. Look, here's what I want you to do tonight, not next week, tonight. Pull up your insurance app or find your policy online. Find the declarations page, read it for 10 minutes, know what you're actually paying for. Then get 1 quote from a different company, just 1. See what comes back. If you saved even $300 from making one of these changes, that's worth a like on this video, right? And it helps this channel reach more people who need to hear this stuff. Because most people are paying for a product they've never actually looked at closely, hoping it'll work when they need it most. You're not most people. You watched this. You know better now. Subscribe if you want more of this. No hype, no shortcuts. Just money stuff that actually matters. I'll see you in the next one. Take care of your money.